Eric and I are delighted to welcome the dynamic duo of Karen and Kari Picarello to our webcast today. This mother-daughter team brings a unique perspective and combined experience of 52 years to the Scottsdale and Phoenix metro real estate market. With a passion for helping buyers and sellers move, they have built a reputation for exceptional service and market expertise. Over to you, Eric.
Well, thank you again for joining us today, Karen and Kari. So maybe we just start out with how would you describe the overall state of the housing market in Phoenix and Scottsdale right now?
It's in my experience, it's kind of a slow market. Not as many transactions, not as many listings, fewer buyers. And we've been going from a slight seller's market for over the last year into a balanced market, which we just hit this week. Do you have more to say about that?
Affordability has improved a tiny bit, but it's still pretty sluggish, and inventory is still down, even though it's up 55% from last year, but it's still down historically. So there's still not a lot of good houses for buyers to choose from, even if they could afford it.
So how has the market changed in the past year? And then what do you foresee, say, between now and the end of the year?
We've been working towards balance. We've been coming kind of from that seller's market, gradually coming towards balance in the last year. And in the next 6 months, I mean, seasonally right now where we are, it's really hot. So everything over $1 million is kind of dead right now. People don't like to move when it's that hot, especially people that are in that luxury market. So
they're out of town.
Yeah, they're not coming back until probably mid-September, October. And there is a little bit of an August rally going on, though. So we've already seen in the first week or two of August that because interest rates just ticked down a little bit, there's a little bump in buyer demand and activity where people are thinking, oh, maybe I can't afford this now. So depending on where it's 6 months go, depending on if there's a recession or not, I think that's going to make the biggest difference. Because if there's no recession, then the interest rates won't drop as much or as fast. And if there is a recession, then the interest rates will go down faster and probably more, and that will create a spike in demand. And then we still have this inventory problem, but it'll be a problem for another day.
and if they go down, if the economy weakens a lot, we'll get a deer in headlights type thing for buyers, because nobody will want to do anything if they're not confident, if they don't have a confidence in what's going on in the market.
That's a good point. Like the stock market, the luxury people that are in the luxury houses, they're watching the stock market more than non-luxury. And if the stock market takes a big hit, then they get a little bit deer in headlights and they stop a little bit. So it correlates.
And we're counting luxury anything over $1 million here. It's
just a way for us to.
It's just a marker. It's a big marker. Under $1 million is been pretty much flat as far as listing prices go and sales. So you can actually separate out those two markets. So the average list price in the last year for under $1 million has about been flat. So it depends upon what numbers you use. And of course, the people that are trying to be influencers use the most drastic numbers. So you can't believe everything that you see or hear online.
Right.
So you were talking about the mortgage rates and, if they tick down, maybe you see more buyers. Do you think that the price level that exists in your local market, is that also a challenge for the buyers, or the buyers are all right with the price levels, or are they, kind of hesitant to enter the market and they're hoping for prices to decline a bit?
Buyers are always hoping for prices to go down, always. But with the interest rates coming down, I think it was for every quarter point, it's about a 3% reduction in what the pricing might be. Not that the prices are going to go down 3%, but that they'll get 3% more house for the
Okay.
same money. So, yeah, I think that going forward, that if the interest rates continue to go down, and almost everybody's expecting that to happen in September, that we should get a bump as long as nobody goes into big fear for some reason. So, and the elections actually don't have much to do with the market. The economy does, but not the elections.
So do you have some tips for first-time home buyers in your area?
Yes, we do.
Yes. The first thing is to figure out your affordability. Because the biggest thing for buyers, instead of being focused on, is it a good time to buy or is it a good time to sell, especially in a balanced market, figuring out what your monthly payment will be and what it can buy you, that's probably the most important thing. Because if that matches up with where you want to be and it's in your budget, then that's what you want.
That's always been the first step, but now it's even more important because we don't want buyers to be looking at houses they can't afford or are not comfortable with the payment. So we have to know that first.
And you can work backwards a little bit. You can kind of think of what payment you want. And if you're connected to a really good lender that maybe somebody personally referred to you, they could help you work that out and have a scenario of, okay, if your monthly payment's this, here's your price range. And here's how it'll change if you go up or down $50,000. So that way you really know what you can look at instead of just it being some far wish that's far away.
Yeah.
What else?
I think it's even more important now to work with an experienced agent. I think we've already lost almost 15% of our agents nationwide.
We're projected to lose about 25 to 30.
Yeah. So that actually should help buyers because it's the agents that are either part-timers or not keeping up with what's going on that are leaving. They're saying, this is too hard. I'm out of here. I don't do enough business anyway. So this is too hard. But now if you make sure that you have both an experienced loan officer and an experienced agent, you will come out with a much smoother transaction and get more of what you want. So I think that's important.
Yeah. Other than that, specifically, I would say if you're a buyer under contract right now, don't make any big purchases until after you close. So that means no couches, no cars,
TV,
nothing that'll mess up your debt to income ratio, because the last thing you want is a loan to get not approved at the very end because all of a sudden your debt to income ratio is messed up because you went and put something on a credit card.
And the underwriters are notorious for looking.
It does happen.
Just for closing, just to make sure nothing's changed. And if you've gone to living spaces and bought a lot of stuff, then that could change. Or a car.
A car for sure.
Sure.
Now, one thing we've heard for a long time is this lock-in effect, where I forget the statistic I heard the other day, but it's a fairly sizable chunk of mortgages in the United States. I mean, it's over 60%, I think, have mortgage interest rates at less than 4%.
Yes.
And so that's causing a lot of these folks to stay put.
Yes.
And are you noticing lock-in effect in the Phoenix Scottsdale area as restricting the supply of homes that you would expect to see on the market for sale?
Absolutely. Absolutely. And so right now, what I'm seeing is the only people that are listing their homes is because they have a life event change, not so much just out of convenience, because they look at the new rate and the old rate and look at what they want and they don't like the numbers. So so they're holding on to what they have, and until either rates come down or something happens where they have to move, pregnancy, job change, divorce, any of those life events, then they're probably not going to come on the market very soon.
Now, right now, I think our current mortgage interest rates are well up into the 6%. And we're talking about potential rate cuts coming in September with Fed potential actions. What rate do you think interest rates would have to be before we would start to see an impact on this lock-in effect?
The lock-in.
Oh, the lock-in.
Yeah. For buyers, it would be 6.5 or less.
Yeah, that's what I would say.
But for the lock-in, I think it's going to have to be more in the 5s.
I think in the 5s.
Okay.
Some of the sellers
interesting.
some of them can't afford
Yeah.
a higher interest rate with a new purchase price, and they're kind of stuck in their old house.
Even if they quote are going to downsize, what we're seeing nationwide, not just here, is that once they see the house they want to downsize into, it ends up costing almost as much as the house they have. So that would mean their payments would go up. So that's why they're holding off.
Right. And one final question for you about the Phoenix Scottsdale market. Where are you seeing in the Valley of the Sun that are hot markets, and which markets are you seeing that are cooler in terms of price appreciation at the present time?
The hottest market has toggled between Chandler and Fountain Hills for a few weeks now, but we have these heat maps that the Cromford report gives us. I mean, we subscribe to that, so we get some really good data from them, but it's showing just where the hot markets are and where they aren't. And I'll let you address that.
Yeah. So in 2023, we had mostly hot markets all over. It was mostly seller, but now it's changed pretty dramatically. And Fountain Hills was at #1, and now it is Sun Lakes is #1, and Tolleson is #2. And then you've got Chandler and Avondale just right behind that. So it's really the little area of like Avondale, Tolleson over in the West Valley, and then this Chandler area and Sun Lakes. Those are where most of the contracts are happening right now. And then the slowest areas are kind of more the outskirts of the valley, your Maricopa, your Buckeye. Buckeye was really hot, and now it's the slowest, it's the coldest. So not a lot of movement happening there. So we're seeing a lot more of that movement towards balance. And there's still some weak seller markets around the middle of the valley, but it's mostly pretty
much
balanced.
the outskirts.
Yeah. But as far as appreciation, your highest appreciation rates right now are in Scottsdale and Fountain Hills.
Paradise Valley.
I'll say that again. The highest appreciation rates are in Scottsdale and Paradise Valley. About 8 to 8.3% annual appreciation. And the lowest right now is Maricopa. That's at 1.5% appreciation. But we do have a graph that shows over 20 years, we've been at an average of 5% appreciation. So all the ups and downs we've had, the crashes and the recoveries, it's generally safe to say that you should expect around a 5% appreciation per year. This is for the whole valley. Last year, the whole valley saw a 1.4% appreciation rate, which isn't that 5%, but it's better than it was 2 years ago. 2 years ago, it was 6% lower. And 3 years ago, we have a 9% increase from 3 years ago. So we're still pretty strong. We're not where we were in May of 2022. That was kind of the peak for us because everyone had this under 5% interest rate and people were going crazy and waiving appraisals and inspections, and you couldn't buy a house if you wanted to. And then we had our crash at the end of 2022. That's when our market went down, and the housing market tends to go down first. So before all the other markets and before all these other economic indicators, usually the housing market feels it first. And that's when we felt it. And it was that end of 2022, beginning of 2023. And now we've been kind of in a recovery mode since then. So we've kind of already seen our downturn, I think.
And Tina Tambor from the Cromford Report is the one that gives us this information all the time. And she says that she still thinks that we're a little bit overpriced for that line. So we could go down a little bit more.
Well, thank you both for your insights today.
Thank you for having us.
Yeah, it's been a pleasure.
Thank you.